To calculate deferred tax, we can use the following grid, which is underlined by this formula. The tax base component is our focus for this clip. There are three formulas you need to know: tax base for assets, tax base for liabilities, and tax base for incomes received in advance. The tax base for assets is calculated as the carrying amount plus future deductions less future taxable amounts. Consider a crane with a cost of $1 million and accumulated depreciation of $200,000. The carrying amount of the crane is $800,000. What will be the tax base of the crane? The crane is an asset, and the tax base of an asset is equal to the carrying amount plus future deductions minus future taxable amounts. We know that the carrying amount is $800,000. The future deductions are calculated as the cost less accumulated tax depreciation. If the tax depreciation is the same as accounting depreciation, then the future taxable amount or deductible amount will equal $800,000. Future taxable amounts simply represent the amount that will be taxed in the future. As the asset's carrying amount indicates the amount of economic resources that it was expected to generate, this inflow of economic resources will be taxed in the future. The crane is currently valued at $800,000, and this will represent an inflow of economic benefits that it is going to generate, and so it will also represent the future taxable amounts. The tax base of the crane is $800,000. The tax base for liabilities is calculated as the carrying amount minus future deductions plus future taxable amounts. It is the exact opposite of assets. Consider an accounts payable balance of $500. Accounts payable are deductible when they are settled. What will be the tax base for accounts payable? The tax base for a liability is equal to the carrying amount minus future deductions plus future taxable amounts. The carrying amount is $500. The amount of $500 will be deductible when it is paid in the future. Accounts payable will not give rise to future taxable amounts, so this is zero. The tax base for accounts payable will be zero. The tax base for incomes received in advance is calculated as the carrying amount minus amounts that will not be taxed in the future. Robert is a music teacher who collects lessons fees in advance. Simi's mother paid Robert $1,000 in advance for her piano lessons for the year. The amount is taxed on a cash basis. What is the tax base? Tax base for incomes received in advance is equal to the carrying amount minus amounts that will not be taxed in the future. Carrying amount is $1,000. Tax is calculated on a cash basis, so the entire amount of $1,000 would have been taxed upon receipt. Therefore, it will not be taxed again in the future, and we can thus substitute this $1,000 in the formula. The tax base is thus zero. To recap, there are three formulas for the calculation of tax bases. You should note that the calculation of an asset's tax base assumes that the asset will be recovered through use. However, if management intend to recover the asset through sale and GST is applicable, the tax base calculation would be slightly varied.